Welcome to The Explainer. We're diving into something huge today, a massive shakeup in commercial real estate. We're going to talk about how one single decision has sent these huge shockwaves through the market. I mean, it's affecting everything, from giant skyscrapers all the way down to your local strip mall.
You've probably seen headlines like this pop up, right? They're talking about a fundamental reset. And look, this isn't just some boring financial news. This is a huge, maybe once-in-a-generation shift that is literally reshaping the cities that we live in.
So, what does that actually mean for all those buildings around us? You know, the office towers, apartment complexes, shopping centers? All right, let's get into it. We're going to connect the dots here, starting with the one decision that kicked off this whole incredible chain reaction.
So where did it all begin? Well, it all starts with one move by the U.S. Federal Reserve. Seriously, if you want to understand what's happening to buildings today, you first have to get your head around the financial shockwave that hit the entire economy.
Okay, so to fight off inflation, the Fed hit the accelerator, and hard. They hiked interest rates from basically zero all the way up to a peak of over 5%. And this wasn't some slow, gentle climb. No way. This was the fastest, most dramatic rate hike we've seen in decades.
And that brings us to the very first domino to fall, the cost of money itself. All of a sudden, the price of borrowing just completely changed.
Just think about it like this for a second. Imagine your mortgage rate tripling overnight. That's pretty much what happened for the big developers and investors. The cost of their number one ingredient, capital, it just went through the roof.
And you can see how this plays out for a property owner, right? It's a direct chain reaction. Rates go up, so their monthly debt payments go up. Those bigger payments start eating away at the cash flow, and once that cash flow shrinks, poof, their ability to borrow more money just evaporates.
And the effect here is just staggering. Get this, just a 2% increase in an interest rate can slash a property's cash flow by as much as a quarter, 25%. That is a massive hit to the financial health of pretty much any building.
Okay, so that's the cash flow hit. But let's look at the next domino, which is maybe even bigger. How does this new, higher cost of money change what a building is actually worth? This is where it all becomes crystal clear.
So let's imagine a building, okay? It makes a nice, steady $1 million in income every year. Now, back in 2021, when money was cheap, interest rates were near zero, that building, it could easily be valued at $20 million.
Fast forward to today, higher interest rates. That exact same building, still making that same $1 million, is now worth just $14.3 million. Let that sink in. Nothing about the building itself changed. Not a single brick. Only the cost of financing it. I mean, that's a drop of almost 29%. Can you imagine your house losing nearly a third of its value in just a couple of years? And not because you've got a leaky roof or something, but because of decisions made hundreds of miles away by the central bank.
Wow. So here's the bottom line. This creates a huge problem, and it has a name: refinancing risk. Think about all the owners who bought properties a few years back with those cheap, short-term loans. Well, now they're standing at the edge of a terrifying cliff. Their old loan is coming due, but the property is worth way less, which makes getting a new loan to pay off the old one incredibly difficult.
And this whole new reality, lower values, higher costs, has created this giant chasm in the market. It's led to a kind of standoff where deals just stop.
And here's what that standoff looks like. On one side, you have the sellers. They're stuck back in 2021, anchored to those super high valuations, thinking that's what my building is really worth. But on the other side, you've got the buyers. They're living in the here and now, and their math, which is based on today's high rates, just doesn't work with that old price tag.
This gap, between what the seller wants, the ask, and what the buyer will pay, the bid, it's become so wide that it's basically frozen the market. Nobody wants to budge, and so not many deals are happening.
And you got to understand, this pressure isn't hitting everyone the same way. The office sector, it's caught in a perfect storm, getting hammered by high rates and the whole remote work thing. Multifamily, we're talking apartment buildings, construction is slowing way down. That means fewer new apartments, which keeps pressure on rents. Even the really tough sectors like industrial are finding it super hard to get new projects financed.
So what happens? Well, every single player in this game is being forced to change their strategy. Buyers, they're just sitting on the sidelines, waiting, hoping for prices to fall further. Sellers are having to get really creative with things like financing. And the lenders, the banks, they're tightening their belts big time. They want more money down and much stricter terms on any new loans they give out.
Okay, so where does this all leave us? What does all this mean for the future?
let's talk about where we're headed and what you should really take away from this whole market reset.
If you want to know what happens next, the experts are all watching 4 key things. You've got your economic data, like inflation reports, any little signal from the Fed about what they'll do with rates. And then there's bank health, and maybe most importantly, delinquency rates. That's how many loans are starting to go bad. That last one tells us how much pain is really in the system.
But if there's one thing to really take away from all this, it's this. The era of ultra-cheap money, it's over. Done. That decade-plus run that fueled this massive real estate boom, it's finished. And it's probably not coming back anytime soon.
And this quote here really captures the new way of thinking. Success isn't about just riding a wave of cheap debt anymore. The smart money is now underwriting, which is just a fancy way of saying they're planning for a future where interest rates are going to be in that 4 to 5% range for good. It's a return to, disciplined, realistic financial planning.
And so that leaves us with one last big thought. If the old way of doing things, of financing and building our cities is gone, it really makes you wonder, right? In this new, much tougher environment, who's going to be the one with the money, the vision, and the smarts to build the cities of tomorrow?